What's up, my people? T from Focus Trades, and because it is earnings season, and this is a popular topic at the moment, let's talk about some options earnings trade strategies. All right, I know a lot of people, guys, they like the earnings trades. However, most traders kind of, in my opinion, go about it the wrong way. Earnings, guys, if you're going to buy a call or buy a put and kind of hold it into the earnings announcement, you're kind of going about it the hardest way. For reasons we'll talk about in this video. But the first thing to understand, and I'll make this as simple as I can here, guys. The big thing, right, when it comes to trading earnings is what's happening to those options heading into earnings, right? Leaning into a stock's earnings announcement, there's some uncertainty in the air. As they're approaching the announcement, is it going to be good earnings, bad earnings, positive reaction, negative reaction, So you got all this uncertainty in the air and everybody starts placing their bets. Now, because of this looming uncertainty, a few weeks out from options, guys, and you probably noticed this before, right? A week, a couple days away from options, you want to go take a trade on one of your favorite stocks, and it's like, holy crap, man, these things are expensive. And what's happening is that a couple of weeks out from earnings, because of that approaching uncertainty, the implied volatility starts to spike as the market makers begin to price those options, the at-the-money calls, the at-the-money puts, the in-the-monies, the out-the-monies. The market makers, right, those who are responsible for pricing our options, they begin to price the options, guys, based upon the move that they think is going to happen after the earnings announcement, which we'll talk about a little bit. So they're pricing in a move of, call it 5, 10, 15, 20 points, right? They're pricing in some sort of move that they expect to happen after the earnings are announced. And what happens here, guys, to put it in a really kind of simple fashion, is think of a balloon. Right, a couple weeks out from earnings, those options contracts, all of the calls, all of the puts that expire the week of earnings, they start to get inflated like a balloon. Right, the market makers are pricing in the move that they think is going to happen, and just like a balloon, those calls, those puts, which are typically, a pretty reasonable price, they begin to get super inflated, right? And you'll look at something like NVDA, in the Delta 20s, a couple of days before expiration, got $1 a premium, where typically they got 30 cents. That kind of thing, guys. So this is important to understand what's happening before earnings and then what happens after earnings. Right? And this all has to do with what's known as the market maker's expected move, which I just explained. Earnings is approaching. Market makers, they're taking those calls, they're taking those puts that expire the week of earnings, and they're pricing them based upon what they think is going to happen. Right? So they look at the calls, and they're going to price those calls, and they're going to juice them up to a price that they think is appropriate for the move they think would happen to the upside. They do the same thing to the puts, right? They pump up those puts, and they get super expensive as the market makers are pricing in how much they think the puts should be worth if the stock makes its expected move to the downside. Now, here's the key, guys. Go back and picture that balloon, right? They're pricing in some sort of move. Right, and we'll talk about NVDA so you guys will understand it better in a second. But the market makers, they're pricing in what they think the stock is going to do up or down. That's why those options get all of that value. They're being priced upon a move that has not happened yet and could not happen. And this is the key. If the stock does not make at least its expected move up or down, the options lose significant value as the move that they were being priced upon, right? The move that was being priced into the calls and priced into the puts did not take place. So the market makers are pumping up those call balloons, right? They're pumping up those put balloons, say based upon an assumption that, the stock's going to go up at least 10 bucks or down at least 10 bucks. So that's the expected move, right? 10 bucks up or down. The stock goes up 8 bucks the next day, right? It goes down 7 bucks the next day. It doesn't matter. If it doesn't make a bigger than expected move, they get popped, right? They were being priced upon a move that did not happen. All that implied volatility gets sucked right out of those bad boys, that balloon, getting popped. So think about that, right? You hold the call into earnings. Think about all the crap that has to work in your favor for your call to hold value, never mind make some value. There has to be favorable results from earnings, right? The company has to have had a good a good quarter. Then you need a favorable reaction from the big money and the analysts doing upgrades, downgrades, all that stuff. And then you need the stock to make a bigger than expected move. So think about that. If you were to hold the call on, say, Apple, into earnings, and the market makers are pricing in a $15 expected move, now think about the things that have to happen for your call to hold its value. Apple has to most likely beat earnings and have had a good quarter. You then need the analysts, the big money, the hedge funds, the institutions. You need them to have a favorable reaction, right? You want them to come in and start buying Apple. And then you need the stock to go up more than the market makers thought it would. You need a bigger than expected move. You have to be right. The market makers have to be wrong. That's a good way to look at it. That's a low probability trade there. So, here's what I suggest, guys. In my opinion, the best way to trade earnings is to construct trades that benefit from that IV crush, right? Or to make it simple, we want to do earnings strategies that are going to make us money if the stock does not make a bigger than expected move. In other words, we want to make money if the stock does not have some huge surprise to the upside, right? Or some huge surprise to the downside. In other words, we want to take trades into earnings, guys, that have the highest probability of working. Especially on a stock that makes a crazy run into earnings, what tends to happen most times is that the news has been priced in, the stock goes nowhere. That's what we did yesterday, guys, or last week rather, in the Focus Trades group with myself, and the team here during our live stream. About 30 minutes before the close, we did an Iron Condor on NVDA. Now, guys, I'm going to keep this video short. If you're not familiar with the concept of an Iron Condor, I would pause this video, I would go onto my channel, search Iron Condors. I got a couple of lessons on there that will explain the basics of that strategy. It's important to understand how an Iron Condor works to understand what we did here, but I want to make this given video a bit shorter, so if you want to learn about condors, you can do so on our channel. But 20-30 minutes out from earnings, guys, we did an Iron Condor on NVIDIA, selling the at-the-money calls and the at-the-money puts. And typically, when you do an Iron Condor, right, if you understand them, you're shorting out the money puts and you're shorting out the money calls. Not for this one, guys, right? We're doing it right at the money. So what we did was we shorted the 250 calls and we shorted the 250 puts. Now, why did we do this, right? Well, the first reason, guys, is that we've seen a pretty common trend here this earnings season, particularly with these big names, right? Which is that, and we'll take a look at Amazon here, it makes a ridiculous move into earnings, again, as any kind of good news is being priced in, and then we go nowhere after earnings. Netflix makes a crazy run into earnings, guys, $300 to 400 plus. Pricing in the good news, earnings comes out, the stock goes nowhere. So NVIDIA, guys, the reason that we did an Iron Condor was a combination of the fact that it had made a crazy run, just like Netflix, just like Amazon, into earnings. So there's a big probability, right, that any kind of good news is being priced in. Then, guys, was the expected move. Right? This is what really made this trade, an attractive idea here. And this was a fun one that we did, live in the group. So the expected move was 22 points plus or minus. Right? That is what the market makers are pricing in. So a couple of weeks out from earnings, right? A few days out from earnings, 30 minutes out from earnings, when we placed this trade, all the NVIDIA calls, all the NVIDIA puts were being priced upon an assumption that we're going to go up at least 20 plus points tomorrow or go down at least 20 plus points tomorrow. So that was the expected move, guys. And just like the balloon, right, it's getting pumped up, pumped up, pumped up. For those calls and those puts, Friday morning after the announcement, to hold any of their value, we needed a bigger than expected move. We needed plus 25 points to the upside, plus 25 points to the downside. That didn't happen. As we can see, the next morning, we basically open up flat. Right, earnings comes out, guys. We kind of open up flat, and you're trading flat all morning, right? A little bit of a move, but nonetheless. All of the puts that expired that Friday, they needed 330 or lower to hold any value and make value. The calls, they needed 370 plus to retain any value and to make somebody any money. This worked out perfectly, guys. Because we opened up essentially flat, we did not make the expected move to the upside. We did not make the expected move to the downside, and now think what happened here. We did not make the expected move. Right? Here's the calls that we shorted that were all juiced up into earnings. Here's the puts that we shorted at the money that were all juiced up into earnings. We get a less than expected move. What happens to those calls, guys? Right? Those calls, they lose all that premium, gets sucked out of them, right? They were pricing in a 20-plus point move. You didn't get it. That balloon gets popped. What happens to those puts? They were pricing in a 20-plus point move to the downside. That did not happen. That balloon gets popped. And for those of you guys that are familiar with option selling strategies, obviously this works in our favor because we shorted the 350 put. We shorted the 350 call. They both lost significant value the next morning, and we got to pocket all of that premium. Now here's what's really cool about this. This wasn't a planned trade of mine. We were more so doing a live stream, kind of talking into the close. The topic of earnings came up. We threw this on with very small size. But what's cool, guys, is that we doubled our money on this, right? Now, I did this super, super small. Again, this is more just kind of a class example for the Focus Trades family. But, 20, 30 minutes before the close, before the earnings announcement, we sold an at-the-money Iron Condor on NVDA. You guys can see, right? We were shorting the 350 call. I'm sorry, we were shorting the 355. Yes, the 355s. Shorten the 355 call, shorten the 355 put. So the Iron Condor, guys, we sold, right? We sold 2 at $4.65. That's a value of $930. The next morning, we did not see the expected move. Just like balloons, those options get popped. All that value gets sucked out. We are able to buy back the Iron Condor a couple of minutes after the open at $4.09 for a value of $818. So if you subtract the $930 from the $818, we get a $112 profit, which is phenomenal when you guys consider the fact that we only needed about $99 plus to get the trade on originally. So you doubled your risk here on a simple trade. You did not need a particular reaction. NVIDIA beats earnings, NVIDIA misses earnings, no difference for us, right? NVIDIA gaps up, NVIDIA gaps down, no difference for us. All we needed for this trade to work was for NVIDIA to not go up or down more than 20 points the following morning. Because we opened up flat, it was absolutely perfect. The calls that we shorted at $11.19, we're buying them back for $5. The puts that we shorted at $13.69, we're buying them back for $4.21. So look how much value these freaking things lose because the expected move did not take place. Now, max profit, guys, in this trade would have taken place if NVIDIA had basically closed right around 355. Then both sides of the Condor are going to expire as close to worthless as possible. That would have been $930 of profit. So, the max potential in this trade was crazy considering it only took us about $100 of risk to get onto the trade. But I didn't want to hold on, guys. We took the quick double and got the hell out of there. But this is a great example of a higher probability trade into earnings. You're not calling direction. You're not relying on the stock making a bigger than expected move. You're looking to take place, guys, with a phenomenal risk reward. You're looking to, take advantage of what tends to happen after a stock has made a crazy run into earnings, which is that the good news is priced in and she's going nowhere after the announcement. So I know it's a lot, guys. If you're a newer options trader, go check out the rest of the videos on the channel. Begin to piece these things, together nice and slowly. For those of you with a bit more experience, something to try out here, right? Go find some names into earnings. Look for some that have made big moves prior to the announcement. Look for those that have big expected moves. These trades can be pretty fun. So if you guys enjoyed this video, please hit that subscribe button. I really appreciate it. And if you're interested in learning more swing trading strategies and different option strategies, be sure to keep an eye with us here at focustrades.com, as we're going to be releasing info on our summer swing trading course pretty damn soon. So that's it for me now, guys. I'll talk to you all in the next one. Peace out.